another section of the School of Stocks. I'm your host, Victor Dongo. Today, we shall be moving on from the income statement onto the cash flow statement. Remember, yesterday we spoke about the income statement whereby we made a profit of $2.51. Now, cash is king. The profit that we saw from our sales of $10, we shall actually go on to further analyze that to make sure that we actually got some cash in our pockets. Remember, we had $10 at the start, and we bought flour for $1, sugar for another 50 cents. Of which we used some of those for making 12 cupcakes and selling each for $1. We sold 10, therefore we had a revenue of $10. Right now, what we shall be doing is moving that net profit of $2.51 onto the cash flow statement for analysis. The cash flow statement is subdivided into three portions. What happens here is we look at the money that we generate from our core operations. Then secondly, we move on to our investments to grow the business or to actually maintain those parts of the business that have been depreciated so that we can keep our competitive advantage. The other part is the financing activities, how we sell equity or how we buy equity, how we service our debts, all sorts of things, how we move money here and there. If a company actually makes money, it doesn't go borrowing or selling equity all the time. That's very simple. No matter the numbers that you have in your income statement, in your operations, you massage it, you do this, you make it beautiful. If you don't make money, it is going to show in how you run your finance. It's going to tell that you are mismanaging money and you are wasting money. So this is where I actually run to first. It's funny that I actually start from the very bottom to look. So that is where I will encourage you to look at, to build the picture. A very good picture for you to move on. So let's move on to the issue of the net profit. So we bring in our net profit here. So we are now starting to make adjustments to our net profit of $2.51. So the first thing we do is there are some non-cash charges which we add back to this number. In our income statement of yesterday, it was so basic that I just decided not to put in things like depreciation, amortization, and other charges for losses or recognizing losses and stuff like that. So, but if you did, this is where you need to add those things back to. So here we are looking at, for instance, let's just pluck out a figure. Let's say we actually bought an equipment for $5. Equipment for $5, and then we are going to use that. We're looking at the life of the equipment to be roughly 5 years, and we're going to be depreciating by 20%. So we are going to take each year. We're going to see each year of our operation for which we are doing these statements for. We're going to say the equipment is going to be worth $1 less. So in this case, if we take a charge of $1, the equipment at the end of year one becomes $4, and then that's $1 that we have removed from this equipment. We are going to charge it through the income statement. So that part of the income statement becomes depreciation. That $1, we are not going to pay tax on it. So we are going to come back. We're going to have it in our pocket as a result of that depreciation. So it's like we are getting back the money for which you have spent on purchasing this equipment. So that money, we're going to come back right here and say depreciation $1. I'm making this for argument's sake. I remember that we didn't speak about equipment yesterday. I just wanted things to be very, very simple. If we then move on and say, okay, what are the other things that we need to recognize? Our income statement is so small, or is so simple, that there is not a lot to recognize. But let's say we bought, in addition to this flour here, let's say we bought another flour of $1. So here in our, we'll say, inventory. So because we are spending money, because we are giving money out, in the cash flow statement, anytime you give money out, it is denoted, or it is recognized as negative. So when you're getting money in, it's positive. When you're giving money out, it is negative. So in this case of inventory, we are actually giving cash out. So we are increasing our inventory. So what we now have is going to be minus the money that we spent on buying that inventory of $1. Then also remember that yesterday when we sold our cupcakes, we sold 7 and we got payment for 7. What we didn't get was for the other 3. So here again, we recognize the other 3 that we didn't get money for, which is called receivables. So we have receivables for $3. So it actually means that for $3 of our money is out there. So it's like we are taking money from our pocket and paying on behalf of that person who took this cupcake but didn't pay. So that is why our receivables is increasing. Then the other one is payables. Sometimes businesses actually go out and buy things and they don't pay right there and then. So it's like they borrow. Let's assume they supplied us 20 cents worth of papers. We have 20 cents worth of paper that we have not paid for. So that is where we put the payables. Payables is like you are getting that thing, you are getting the money in, and you have not paid for it. So you've gotten the value of what it is that you want, but you have not paid out cash. So here we connote with a positive sign. So we are now saying for 20 cents we have our payables. So receivables, payables, inventory. All this, what you call your working capital. For us to actually see if we have made money from our operations, what you then do is you add all of these together. We are going now to be 29 cents out of pocket. So really, at the end of the day, when you look at what you have done for the year, you are going to see that you have not actually made any cash, even though you made a profit of £2, $2.51. You have not made any cash. You're actually out of pocket. Right. This is not even the end. This is not even the end. Remember, you are going to invest. Investment. So, you have finished operation, you're going to invest. Remember, you depreciated $1 from your equipment. This, you're going to need to find a way to either replace or repair, or if you feel like you want to grow, you need to invest more. So let's assume that under investment, you have maintenance 8 cents. Then you bought new equipment but another new equipment for $2. Look, just look at right now. You have not made money. You are spending money on maintenance, and you are buying new equipment. So let's just stop here, not go any further. So for investment, you already have $2.80. Remember, you have not made money here, you have spent money here. So if you fuse those two together, you're going to be $3. So that plus that is going to give you $3.09 out of pocket. Yeah. How are you going to cope? How are you going to cope? Remember, we started with $10. So you bought this, you bought that, you bought this. So at the start, you actually spent about $6.50. That was what you spent at the start to get yourself off. If you take $6.50 from $10, you're going to have $3.50. So it means somewhere you still have $3.50 to play with. So perhaps that is where you bought all these things. If we now go to our finance, we then look at the money we are bringing in via borrowing or sale of part of the stock for this company. Here, let's assume that a friend, John, borrowed us $6. At the end of the day, you can see how some companies will have cash in their balance sheet, but the cash is not from operations. So that also, I told you at the beginning that, look, when I'm looking at a company, I go right to the bottom and look at what they are where they are getting their monies from. If they are abusing from equity, abusing from borrowings, then most likely their operations are not doing well. Remember, here they had a net profit of $2.51, made no money, and they had to spend to invest on maintenance and new equipment. And now they are going to John to borrow $6. So if they made money, they wouldn't be coming to John to borrow. So if we now add $3.09 to $6, $2.91 of net cash from the cash flow statement. So this is going to be our final cash that the business gets after running for the year. Of this $2.91, remember, most of it came from $6 from John. If we didn't have this $6 from John, this is what the business would actually be standing at. We would not have enough money, we'll be out of pocket, and in some cases, if you don't get to borrow, you go out of business. So in a way, you are making money in your net income, but you are not making money. You are not making cash. Cash is king. So that is where we are right now. So if you look at this, at the very beginning, we had a net cash of $3.50. So if you take this one right down to this place, you add, when you add 3 to, when you add, you then have something like total cash will now be total cash that will appear on another part of your financial statement called balance sheet would now be equal to $6.41. So in a way, you actually see that, oh, the balance sheet has cash of $6.41. The question is, where is this cash coming from? If you take away John's $6, you'll be left with just 41 cents at the end of the day. And I'm sure this business, if they don't find a way to get more money, they will not succeed. Ladies and gentlemen, this is the cash flow statement in a small form for you. Next time, we shall be talking about the balance sheet. Thank you and have a lovely day. Bye.